Hi, everybody. I'm Glen and I'm here. This is Choose FI Baltimore, Greater Baltimore area. Thank you for coming. I'm going to be talking about ESPP today. This is one in a series of presentations that we are taping for Alex's YouTube channel, and he's going to be presenting later. We've had previous presentations by Frank Vasquez about how to diversify when you retire and the safe withdrawal rate and how that gets calculated. We've had Tommy Doggs on a video version, a Zoom version, do a couple of videos, a two-parter on crypto. And I'm going to be doing ESPP today. And we kicked it off with, it was Justin doing their life and to date and his road to FI and how he's getting ready to retire at some point and actually go into his own business. So, so we're going to continue this on now with talk about ESPP. Unlike all the other presentations, they were more strategic in nature. This is a very tactical idea, almost like an employee hack on how to increase your cash flow. It's meant for people who work for stock-based corporations. So people that work for the government or nonprofits, that kind of thing, that won't apply. ESPP stands for Employee Stock. What is the PP? Purchase Program. Thank you. I think I would know. Okay, thanks, guys. It's a cash generator. That's how I look at it. If you listen to the company talk about it, they'll tell you it's a way for you to share in the stock and the value and all that of the company. Maybe they hope you're going to keep it. There may be some tax benefits for keeping it long term, but there's some risk for keeping it long term as well. And in my mind, this works best as a simple cash generator, similar to a bank rewards program, where you put money in the bank. If you leave it there a certain amount of time, you get an extra chunk of money. Right? And I'm going to walk you through how all that works and the kind of return that you can get from that. And I'm going to tell you that the answer is in the neighborhood of 60%. That's what we're going to build up to. That may sound unbelievable. Probably does sound unbelievable. I had to fight with it to understand it, but it's real. Okay. And by the way, 60% is the norm. It will occasionally produce much better than that. Plan conditions for an employee stock purchase program, ESPP, vary, and the details matter. So I'm going to use this as a pointer. The best plans have a 15% discount, which we'll explain, allow for immediate sale, and have a look-back period. And it's the look-back period that can get you much higher returns. Analogizing this to a mythical bank account. So we're going to be setting up a simulation here. It's not a real bank account, of course, except that your money really is being kept for you, let's say in escrow, by the company. So every pay period, a certain amount of money comes out of your pay period. And assuming it's a 6-month program, and that's what most of them are, maybe all of them, I don't know, then twice a year, the company is going to buy stock using that money. And since there's going to be a discount, they're going to buy more stock than you could buy at retail. And that's where you make your profit. So, but we're going to pretend like it's a bank account. And I'm going to simplify things a little bit to make this really easy. The normally, most people get paid maybe every 2 weeks. Some people get paid twice a month. Less people get paid once a month. But dividing by 13 for 2-week periods and trying to do that math on here and walk you through it is too complicated. So we're just going to keep all the numbers as simple as I can. There will be 2 complex calculations, slightly complex, not that hard. But everything else I'm going to try to keep as round and as simple as possible. So we're going to assume an employee's making $120,000 a year or $10,000 a month, just to keep things round. We're also going to assume the maximum contribution is 10% of your paycheck. So that would be $1,000 a month. So month one, you're going to put in $1,000. And again, we're treating this as if it's a bank. And we're going to say this bank pays 12% interest to start. And again, this makes it real easy. That's 1% a month. Okay. So the amount of interest one would earn at the end of the first month would be $10. Everybody with me? 1% for 1 month. At the end of this, in month two, the beginning of the month, you put another $1,000 in. Only now you're going to get $20 in interest, 10 from the first deposit and 10 from the second deposit. And so on, 3, 4, 5, and 6. Listen quickly. So at the end of 6 months, you'll put $6,000 into this. And each month, this is simple interest, no compounding. In 6 months, there's not a lot of compounding anyway. And if we add up 10 plus 20 plus 30 plus 40 plus 50 plus 60, that would equal $210. Now that's if we're paying 1% per month or 12% annual simple interest rate. We'll fix that, sorry. Everybody with me so far? So if you were to do this at a bank, and every month, first of the month, you put $1,000 in, and it was paying 12% interest, no compounding, simple interest, at the end of 6 months, you'd have $6,210. And you take it out, $210 profit. That's what 12% looks like. But I said we're going for 60%, or 5 times that. So we should be looking for a number that looks something like 5 times 210. The 60% is approximate. The reason why, so if you look at 6,000 against 210, that doesn't look like 12%. But this $1,000 was in for the whole 6-month period. But this $1,000 was only there for 1 month. Okay? And that's why these numbers come out the way they do. So you really only earned $10 on this one. You earned 60 on this one. They kind of flipped these numbers. Okay? So now we get to the calculation. We're going to assume, for the purpose of this first calculation, excuse me a second. That the price of the stock is $20 a share. And if you were to get a 15% discount on that, that would be $17. $3, 15%. Okay? So the company, what's going to happen is, at the end of the 6-month period, for real, the company's going to take this $6,000 and they're going to go buy stock at $17 a share. They're going to take the $3 loss. That's really going to be income to you. I did my math right. That's going to be 352 shares. It's actually 352 and a fraction, but in my company's case, they only bought whole shares. And whatever the leftover was, they stuck in your next paycheck. So in this case, it's $16. And so you end up with the $16 will get returned to you, but you have the opportunity to sell it at 20. So they pick 2 dates a year. They take the closing stock price of those 2 dates. It was June 15th and December 15th in my company's case. And the next morning, those shares were in my account. What account is exactly? Well, they've made arrangements for you to have an account at a brokerage where they're going to deposit this. You do all that username, password stuff, link it to your checking account, all that kind of stuff ahead of time. They give you all the instructions for that. So that's ready to go. You know the website, or you can use the app on your phone to log into that brokerage site, and you're ready. You get an email 9:30 the next morning, 9:40 the next morning. It's usually a few minutes late. Says the shares are in your account, or you're just looking at your account waiting for the shares to show up. So 352 shares. Now, we all know stock prices waver from day to day and from minute to minute. So the closing price was $20 last night. Opening price might be $19.94 or $20.10. It's good. That's reality, right? We're just going to use the same 20 for right now. And you're going to sell immediately. And if you sell immediately, that's 20 times 352. And that's $7,040. So on your $6,000, you've just now made $1,040. Plus there's $16 left over because it didn't equal out exactly the amount of shares, and that will end up in your next paycheck. So that's $7,056 returned to you. This is assuming you sell immediately. So when you get that email that says the shares are in your account at 9:40 in the morning, you're online, excuse yourself from any meetings, and you're going sell, 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 sell. And it takes about 5 of those because you got to go in, find the number of shares, and it says sell. It says, how many do you want to sell? And there's a little all of them button. You click the all of them button. And then do you want a market order or a limit order? So you just keep clicking like, no, I just sell, like now, do it. And you get through all of those, and then it'll tell you what the exact amount was that you got. Again, it might be $20.10 at this point. It might be $19.48. Market goes up and down. But you want to sell immediately. If the price held the same, you'd have $7,056, which is $1,056 in profit that's going to go right back into your checking account in a couple of days. So we had said if I multiply this by 5, I get 1,050. So if this is what 12% interest would pay, if you deposited the money in a checking account or a savings account, and you were getting 12% interest, and you did it in this order, $1,000 each month for 6 months, you would make $210. In this example, we're making $1,056, which is approximately 5 times more. So what I'm telling you is you're earning 60% of your money if you will sell immediately, more or less, because it might not be $20, it might be $20.15, it might be $19.87. Whatever the number is going to be, you don't care. Whether you end up with a 60% return or a 54% return or a 63%, it doesn't matter. This is $1,000. Bank it immediately. That is what I learned to do over time. You have another option. You can hold the stock. If you hold the stock long enough, you'll get the capital gains tax rate. But there's a risk here. This was your paycheck money. And if that stock drops in the year or two that you're holding it down below 17, you just found a way to lose money on the transaction instead of pay the taxes. So I'm going to suggest when you're making a 60% return, you don't mess around, you pay the taxes. How often do you get to make a 60% return? With me so far? Make sense? Let me stop here and ask if there's any questions. Okay. Now we're going to take a look. So that was the discount and the immediate sale. Now we're going to talk about the look-back period. Most of these plans are going to purchase at last night's closing price, you put the money in the account this morning, and then you go sell. But many of the plans will pick the lowest of some number of prices. Most recent one that I did, it was the price 6 months ago or the price 1 year ago. It's a 6-month plan, so they're just looking at the prices previously. It will take the lowest of those 3 prices. So if the stock has been going up, you're going to make a lot more money. And I'm going to show you that with an example. I'm going to erase the first one so I'm not writing down at the bottom of the board. Remember, that was 352 shares. So let's assume that a year ago, the price of the stock, what did I put down here? Otherwise I'll have to get out the calculator and pick a different amount. All right, let's assume it was $15 a share. So your stock has gone up in value 33% in a year, from 15 to 20. It had a good year, okay? Not going to happen every year, but it can happen. In that case, you're going to get 470 shares. In other words, it's the same amount as $6,000. Oh, the discount. This is going to be $15, and it's going to be 15% off of that. So the price that it's going to buy the shares at is $12.75. Right? We're taking 15% discount on the lowest of 3 prices. Last night's, 6 months ago, or a year ago. So if the price was $15 a year ago, then 85% of that is going to be $12.75, the 15% discount. Why would the company decide? It's part of the portfolio of benefits that they're legally allowed to offer you, along with the 401k match and the other things in addition to your salary, to try to retain you as an employee. You could think of it as it's probably not a golden handcuff, maybe it's a silver handcuff, because this $15 price is going to be good 6 months from now when the price went up to 17 on its way to 20, and then it's going to be good at 20. So it's going to keep you there another year if you see the stock going up. And if the stock keeps going up and you're looking back, then you're going to say, I'm going to get this incredible return, which I'm about to calculate for you. Does that make sense? Yeah, it just sounds like too good to be true, and I feel like there should be more of a financial benefit to the company for choosing it. But if the main benefit is the employees there, then the few who are smart enough to catch on. Correct. Again, they'll sell this as making you a shareholder and the benefits. And when the stock is going up and you keep it for a while, then yes, you can, if you decide to hold on to the stock, and you're right, your crystal ball is working, and it goes up, then you'll pay the capital gains tax rate versus the ordinary tax rate on this income. But I'm saying when you're making a 60% return, you don't mind paying the ordinary tax rate. Just bank the money. By the way, the 60%, let me caution you, that's an approximate number. It's sort of a mathematical number. In practice, it's going to be off a little bit because there's going to be a delay from the date that they purchase it. Then it has to go to settlement for 3 days for the money's in your account. And then you're going to transfer it from the brokerage to your checking account. That may take another 2 days. So you're not going to actually see the money maybe almost a week later in your checking account, that kind of thing. So it depends how you're timing and calculating the actual return. Plus, they're doing it on 2 specific days of the year. Your paydays may fall on different days. And so there's a gap between the last paycheck and when they actually purchase the stock. So this is not a 100% perfect analogy to a bank where you're putting the money in and you know the date you deposited the money and you know when the 6 months is up and you go cash it. It's going to be slightly more. And so the return might be slightly less than this. But in the example I'm about to show you, the return is so far superior, again, it doesn't matter. So because you're buying at $12.75 a share, $6,000. If you do that calculation, you'll come up with 470 shares, and you'll have $750 left over that'll get returned to you in your next paycheck. If you go and sell, and again, the price is stable at $20 the next morning when you go to sell, you'll get $9,400 plus the $750 returned to you. And so that's $94,750 on a $6,000 investment, for which only $1,000 was at risk for 6 months, and the last $1,000 was only at risk for 1 month. And nothing's at risk, by the way. When I say that is, you can get this money back at any time. So let's say you're 3 months into the program and you quit the company, or you're 3 months into the program and you have some major emergency expense and you just feel like you cannot stick it out for the rest of the program. They'll have a procedure, you'll write them something, and they'll cut you a check, and you'll get your money. They really are holding the money for you. So I will say, in another answer to your questions, they budget a certain amount for this, like they budget for all benefits, for your health care and everything else. They budget a certain amount for this too. And after we're done, I can talk a little bit more about that and what the implications could be for that. But I mean, obviously, to make $9,400 plus the $750 on $6,000, for which only $1,000 was out there for 6 months, like that return's too hard to calculate. It's too high. It's not going to happen every time, but when it does, it's nice. So if you do this a couple times a year, you know, it's a couple extra $1,000 in the checking accounts, how I look at it. You spend it however you want. You can take a vacation, you can invest it, you can do whatever you want with it. You have a couple $1,000 to spend that you didn't have. The first 6 months is the most painful because you were used to a paycheck of a certain amount and you just took that money out of that paycheck. But after that 6 months is over, you're getting it all back. You could take the amount you contributed, put it back in your checking account, and take the profit and only go spend that if you want. Because you can use that to sustain you through the next 6 months. So it's only the first 6 months that's painful. So you're getting it back, right? And every once in a while, you're going to get a nice payday out of this. So in the plan that I had, it was a 10% of your salary. And this goes to the question, and it goes to the question, remember I said they budgeted a certain amount for this? The first time they issued the plan at our company, the limit was $25,000 a year. It wasn't a percentage of your salary. A lot of engineers at our company, they can do math. The question was, what's the most you can put into the program? Because it sounds so good, why don't you just put your whole paycheck into it? So when the first iteration that our company did, it was a $25,000 maximum contribution. I told you they budgeted something for this. Well, too many people took advantage of it. So the price of the stock had gone way down and it was starting to work its way back up from the bottom of the roller coaster. And they jumped in, signed up for the plan, and in some cases they were doubling their money. So the stock really went down low. So when it came back up, and you took the 50% off that lowest point, and it was a 2-year look back originally. So people had $25,000 of their paycheck going into a program where they were doubling their money every 6 months for 2 years. So they ran out of money. They literally had a budget to buy certain X amount of shares, and so they had to scale it back. Basically, they did it evenly for everybody. They said, sorry, this year we can't do the 25. You know, you're going to get less shares than you thought you were going to get, and you'll get your money returned to you, but we can't afford this. So again, it's just part of the benefit plan, and they budget for it, just like they budget for your health insurance and everything else. And it is it's a retention program idea. So the second iteration of the plan they did was only a 5% discount, and nobody signed up for it. So they compromised. They went back to 15%, 10% of your paycheck, and they figured they could afford that. And a 1-year look back, so 6 months or 1 year, those 2 points. And they figured they could afford that, and that maintained for a long time. Now, I was one of those people who didn't always sell right away. And again, my company stock was a bit of a roller coaster. So there were periods there when I was underwater. And that's, again, that's your paycheck money. This is not gambling money. This is sure thing money. Like the only thing that's not exactly a sure thing is that 10 or 15 minutes when you're trying to, get the sale or the transaction to go through. You hope there's no major event out there that causes the whole market to tank. But other than that, you're going to do okay. Anything else? See if I have any notes.
Is this primarily limited to publicly traded companies and any privately trading companies that you are aware of that do this? Or
I don't know if any, like there are companies that issue stock, but they're not on the market, right? They haven't gone public, or they're purposely held as like employee stock-owned companies, and so they don't trade on the market. I don't know if those companies are doing it or not. You'd have to check with your plan benefits. But clearly, government employees, small firms, if you work in a law office or something, any kind of company that does not issue stock, that if it's set up as a partnership or something, it doesn't apply to any of those. Any nonprofits, it only applies to companies that issue shares of stock.
So the benefit basically goes away once you get rid of your discount pricing. There's almost no benefit to it. It's basically just it's a compensation that part of your compensation is split off into stock. And in order for you to see it and realize any of it, you have to cash it out.
Correct. We live in a world, especially in the Choosify community, of people who are mostly buy and holders, right? You're in your accumulation phase. You're just buying, and you're buying your low-cost index funds, and you're buying it you're sticking that in your Roth or your 401k, your 401k Roth, or you have a brokerage account and you're doing the same thing. Maybe you're playing with individual stocks on the side. Maybe you feel like you know what you're doing and you're doing that in large scale. But generally, we're thought of as people who buy and hold. This is not buy and hold. This is buy and get rid of immediately, bank the profit, take the cash. It may disappear tomorrow. This is your paycheck money. This is not your investment money. This is just to give you more money in your checking account. I'm just giving you my personal idea of how I look at this after years of sometimes not selling immediately and watching the stock tank. And, eventually selling, but at a big loss, depending on how long it takes for the stock price to come back up, if ever. So I worked for one of those companies where the stock went so far up in valuation, it was ridiculous. And it eventually came back down to earth, and it never went back up there again. So I learned my lesson the hard way. Any other questions? Sure. So in the simple example, the night before, the company's going to take the closing price. They're going to apply the discount. They're going to buy the shares at that discount price. If it's 15% discount, the $20 example I used, they'd buy it $17 a share. With the look back period, they're going to take the lowest of some number of prices, depending how far the look back goes. So in my most recent example, it was a 1-year look back. So they look back at the 6-month purchase price and at the 1 year ago purchase price. So whatever day, they pick 2 days a year that they execute. And they execute, unless it falls on a weekend, then they obviously do the Monday after. But they are consistent, but they're always buying on those dates. So they're looking back on a 1-year look back. They're going to look back at the 6-month date and at the 1-year date. Whatever the lowest those 3 prices are, last night, 6 months ago, and a year ago, that's what they're going to buy it at, less the 15% discount. You're selling, at 9:30 in the morning or 9:40 in the morning when that stock is in your account, and you're selling it on the market. Yes, so the risk you have is that from the time it closed last night to when it opens in the morning, that it tanked more than 15%. That's your risk. How often does that happen? I mean, I'm not saying it never happens. Sometimes there's some major event in the global economy, or there's some major crisis in your company, and there's a very quick drop in the stock. But that's, for any one company, that's a rare event. No. You're always buying. When they execute, I'm saying buy it immediately. The price is determined based on the look back period. So if they bought the stock last night after the market closed, they're going to buy it at one of three prices: 85% of last night's close, 85% of 6 months ago's close, or 85% of a year ago's close. That just determines the price at which they're going to buy the stock. And that determines really the number of shares of stock they're going to buy, because they're going to use your same $6,000 to buy with. You gave them, through a paycheck withholding, $1,000 a month for 6 months. If it was a biweekly paycheck, you would just divide this $6,000 by 26 or by 13. And it would be, you'd get the biweekly amount. But this is the amount that's going to be spent. The price is either going to be 15% discount on 20, which is $17. That's the worst case that they're going to buy, and that determines the number of shares. Or if the stock was cheaper 6 months ago, or if it was cheaper a year ago, the closing price, they'll buy that. So in this case, I'm using $15. So let's say a year ago, the stock was $15. They're going to buy it for $12.75. What that means is they're going to buy a lot more shares. It was 352 shares here to get $6,000. And here it's 470 shares. And that's the number of shares they're going to deposit in your account. So in this, what I'm advocating is you hold that stock for the amount of time it takes them to deposit in your account, and the amount of time it takes you to push the 4 or 5 sell buttons you got to push to get the transaction to complete. You really weren't holding the stock very long. It's really a bank transaction, right? Here's 6,000. They put in these shares. The shares are trading today at $20 a share. Might be 2005, might be 1997. Stock prices fluctuate throughout the hour, throughout the day. Did I answer your question? Okay.
So just for my own understanding, because so the money that you've been paying for the past 6 months is not purchasing the stock at the price at the point that you're paying.
No, it's going into a mythical bank account.
Okay.
In your name.
Okay.
You can think of it as being an escrow.
Yeah.
Okay. The cash is building up. One of the things they may be doing is they may be making a profit on that cash that's building up. They can't touch the cash, but it may be invested in like overnight securities or things that are stable and guaranteed. In today's market, they're not going to make a lot on that, but that may be one of the things that they're doing to help offset the cost of this. I don't know, but it's your money, and you can get it back anytime, like I said. So, does that make sense? Yeah, you're confused, and it's okay. Listen, I fought with this thing. With the guy who explained this to me, I wrestled with this for a while until I got it. So but the stock is not purchased until the night before, after you've accumulated, this money's accumulated, right? Right. You've been accumulating money in a fictional account. I mean, it's not fictional. They really are keeping track of this. Okay. It's just not at a real bank where you could walk in and pull them. You can get that money anytime if you really wanted to not wait for for it to end. But there's no stock purchased until all of this money is accumulated. Okay. It's a one-time purchase, and it's based on last night's close, or 6 months ago, or a year ago, or if you have a 2-year look back. You do not. Yes, sir.
Will provide a point of clarification, because Glenn and I went through this exercise about a year and a half ago, and also my my company has an ESPP plan that allows for saving all the money throughout the year, but only execute once a year. The execution happens about a week ago, like supposedly in January 31st, 2022 closing price, and took like then they said they actually take a week for it to come to my account. So what happened was that throughout the year, money is withdrawn from my paycheck to put into that like they call it fictional account. It's basically in my case, a fidelity account, and then over the years, the money keep accumulating on a paycheck by paycheck basis. So, but then those money is not executed in buying the shares until the closing date that happened a week ago. And then 2 days ago, the shares finally went into my account. So there was a little bit of risk in the sense, what if I could lose my discount in that 10 days? I did ask about the HR department, and then they said that's the rule. It would take about 10 days to get it in my account. And luckily, the market has been pretty good. Like I actually make a little bit more money, so I was less anxious about it. So when you worry about prices, the main price worry that you should worry about would be from when the execution date to when the share hit your account. That's my company is a little bit specific. Maybe in other companies, the share would hit the next day. So if the price executes, and then the next day you get the shares, and that's when Glenn would say, just make sure you sell it.
Oh, yes.
Other people to make
Mhm. Yes.
So one question I have, so I currently have access to the SPP plan. However, it doesn't check all the boxes. The only thing that the plan doesn't have, it doesn't have the look back period.
Okay.
Instead, it does, I believe, an average share price over the 6-month period.
Okay.
Just say it's still beneficial to take advantage and sell right away.
So you said the average price, which means it could end up being higher than last night's closing price.
Possibly. I think, they look over a 6-month period and do the
Well,
average.
find out for sure, because in that case, as you got closer and closer to the end, if your stock had been falling greatly during that period, I'd pull my money a few days before the deadline. They'll give you a deadline, you got to pull it by, and I'd pull it, because if they're really doing the average price over that period and the stock had been steadily falling, then the price they're going to pick is going to be lower, than what the current market price is, and you can't sell right away. I mean, you just can't. I mean, you'd be losing money, or a substantial part of the discount anyway. So yeah, I mean, make sure you understand exactly what they're really doing there. My company was fortunate enough to deposit those shares immediately. Again, based the difference in time from last night's closing to the opening market this morning, somewhere before 9:45, the shares were always in the thing. I was in the doctor's office one time. I was still in the waiting, in the office. The doc hadn't come in yet, and I get the notification and it's a bad signal. Excuse me a minute. I walk out of the room, go find a window, and come back into the room. Yes, I'm that intense about it. Like, this is one case where I'm telling you, don't buy and hold. Sell immediately, lock in the profits. This is your paycheck. So that's my point of view, having been burned.
Like I agree with everything that you said, especially with the average, because like it only takes like one day to skew the average, especially in the stock market. Like it can drop like 80% or 90% in one day, and if they're taking the average of the last 6 months. But what I like about this that my previous company, when I was in the private sector, didn't offer was the discounted rate. They just give you a generic stock option, and you have a couple of years before it vested. So
that's a different program. That's like an RSU program.
Yeah.
Restricted stock units.
Yeah.
That's a nice program to have too. They'll give you it invests typically over a 4-year period, and it's paid out quarterly.
Yeah.
So every 3 months you get shares deposited in your account.
Yeah.
And I did the same thing: sell.
Yeah.
Because I didn't have to put any of my own money into that.
So
that was company money. And it's just extra pay. It's just, like, pay this loan off,
So-
whatever.
I should have sold, but I'm glad that I didn't because I never looked at that as part of my paycheck. Because psychologically, like I knew that the company was always going to keep rising, and it hadn't yet matured enough. Well, at the price point where I'm like, oh, there's no more growth. That there was still a lot of growth when I joined the company, and I think that there's still more in the future. So I'm just holding on to that forever. Like, I don't even check up upon it. But if I had a similar program like this is almost taking the risk out of it.
Yeah, well, because it's your money,
Yeah.
right?
Yeah.
Versus the RSUs, that's not your money. That's just every 3 months, some shares show up in your account. You didn't have to pay for them at all. It's a reward for having done good work, or however they frame it for you. And if you never sell them, well, you're not any worse off than you were. Here, if you don't sell them, the stock drops. Well, that was your money. Now, you think about a company that's, Kodak maybe, and it was in a growing period at one time. And if they had a program like this and you held, the price would have gone up and up and up and up, and you would have made a lot of money. You think of Tesla today. But then Kodak, ran over a cliff at some point. Digital cameras came out and exploded, and right. So the healthier company and the future prospects could play a role in you determining when to sell. Alex, you and I were talking about it yesterday. It's the concentration risk. Your whole work is tied up in that company. That's a lot of it's not a net worth thing, but it's the way you earn money. And it's, you could lose your job, obviously, at any time. That's a risk, right? You're compounding the risk if you put your own money into their stock and hold on to it.
That's a really interesting conversation between diversification and concentration. Like the smart money, if you don't want to think about it and want to have like a good night's rest, is to diversify your holdings. But like the reward is like when you're concentrated in one particular sector or company and you know it really well and you're fairly confident that it's going to keep going.
Right until digital cameras come out.
Exactly. So you have to be able to recognize those events. And if I'm being honest, like it's a skill that I lack. But for the time being, at least for my time horizon, but that's how I'm treating those
Right.
RSUs. It's like I'll leave it until some external event, but I'm like, oh shit. So. But I think I'm lucky enough that it's reasonable.
But with the RSUs, that's not your money, right? So if you lose it, you lose it. I mean, it would be a shame, but it's not your money.
I'm not trying to get out of that mindset. I'm being a bit more protective.
Right.
It's I'm gonna keep that money. Yeah, it's not.
Yeah.
It's not technical.
So we accumulate index funds. That spreads the risk. And you're playing for the long haul. There's going to be corrections. There's going to be bear market. You don't care. You're doing this over a 30, 40-year period. Your company might not last. It might get bought by another company. All kinds of things can happen. You don't know. So holding on to one company's stock for this period that you also happen to work at, I mean, you're just adding an extra risk. Just my opinion.
I didn't do that with my company because I didn't understand what you were just talking about with the program.
Mm-hmm. Right. This is why I'm trying to get this message out to people. Because I've made the mistake. But I got the shares when the price was high, and the price went way down, and it never came back up to that other price. Right? And you don't think of the stock market as doing that as a whole, but any one company's stock can do that. So, yes, sir.
I would like to point out that this is the power of having a community here. When I got the job offer, like a little bit over a year ago, there's an ESPP plan. And Glen already, like through passing of conversation, I knew Glen for about 3 years now, and that he has an ESPP. So I just like go to my phone and say, Glen, give it a call and be like, so I have this ESPP plan. Can you analyze this for me? So he went through it with me, and then I kind of just it's a fair amount of money to put into something that you won't touch for a year. Like, I mean, mine only just executed, and my money started going to that account about in January 2021, and it was still COVID, there's still uncertainty, and I was switching to a new job, and Glenn was like, think of it not an investment account. Think of it as like a high yield savings account, that there is some certainty that you get your money back. And then that's the power of community. Like, you know, when Glenn gives that word to me, I was like, okay, let's give that a shot. And a year later, I have no regrets. And that's my first comment. And the second comment is that you seem to have a lot of knowledge in that like restricted share RSP plan. So when you're comfortable, when you do your research, and when you want to take this spot, like and Glenn's spot, just let me know. We'll connect. So
Excellent. Well, thank you, everybody.